Hey, future finance gurus, Professor of Finance here, figuring out how much a company is actually worth? That's the million-dollar question. Whether you're buying stocks, starting a business, or just trying to understand financial news, knowing how to analyze and value a company is essential. In this video, we're diving deep into company valuation, breaking down complex concepts into bite-sized pieces. So grab your notebooks, get ready to take some notes, and let's get started. All right, let's kick things off with the basics. When we talk about analyzing a company, we're essentially trying to figure out its financial health. Think of it like giving a company a financial checkup. We want to know how much money they're making, how much debt they have, and how well they're managing their assets. Investors use methods like ratio analysis, trend analysis, and industry comparisons to analyze this information. Once you understand its financial health, you can start to think about its valuation. All right, let's talk ratios. No, not the kind you learned in middle school math class. We're diving into something much more exciting and impactful. We're talking about investment valuation ratios, the secret weapons in every investor's arsenal. These ratios help investors make informed decisions. These ratios are like financial X-rays, allowing you to see beneath the surface of a company's financials and uncover its true value. They reveal the hidden strengths and weaknesses. Some of the most popular ratios include the price-to-earnings ratio, PE, the price-to-book ratio, PB, which help gauge a company's market value, and the debt-to-equity ratio, DE, which measures a company's financial leverage. Each ratio tells you something different about a company's financial health and growth prospects. They provide a comprehensive picture. The key here is to use these ratios in combination, not in isolation. This holistic approach gives a more accurate assessment. By analyzing a company's ratios in context with its industry, its competitors, and its historical performance, you can start to develop a more informed investment thesis. This method helps in making smarter investment choices. Now let's zoom in on one of the most important metrics for any investor: earnings per share, or EPS. Think of EPS as the heartbeat of a company. It tells you how much profit a company is making for each share of stock outstanding. But here's the catch. EPS can be manipulated. Companies can use accounting gimmicks or one-time events to inflate their earnings in the short term. Look for companies with strong profit margins, efficient operations, and a track record of consistent earnings growth. Now that we've got a handle on earnings per share, let's delve deeper into the metrics that investors use to gauge a company's value. One of the most widely used valuation ratios out there is the price-to-earnings ratio, or PE ratio. This ratio is a cornerstone in the world of investing. This bad boy tells you how much investors are willing to pay for every dollar of a company's earnings. It's a quick way to assess market sentiment. A high PE ratio means that investors are willing to pay a premium for the company's earnings, usually because they expect strong growth in the future. This can be a sign of confidence. On the other hand, a low PE ratio could indicate that the company is undervalued or that investors are not expecting much growth. This might be a red flag or an opportunity. It's important to compare a company's PE ratio to its industry peers, its historical average, and its growth prospects. This gives a more complete picture. Investors are expecting different levels of growth from each company, and understanding these expectations can guide better investment decisions. All right, let's talk about relative value measures. This is where things get really interesting, because now we're not just looking at a company's financials in isolation, we're comparing them to its competitors. By comparing a company's valuation multiples, such as its PE ratio, PB ratio, and EBITDA ratio to those of its peers, you can get a sense of whether it's trading at a discount or a premium. If a company is trading at a significant discount to its peers, it could be a sign that it's undervalued. Let's dive into the world of dividends and how they can be used to value a company. The dividend valuation model, or DVM, is all about figuring out how much a company is worth based on the present value of all its future dividend payments. The DVM is based on the idea that a company's worth is equal to the sum of all its future cash flows, discounted back to their present value. So the DVM takes into account the time value of money and discounts all those future dividend payments back to their present value. It's a powerful tool for valuing companies that pay dividends, especially those with a long history of consistent dividend payments. Get ready to unlock the secrets of discounted cash flow analysis, the gold standard of company valuation. DCF analysis is based on the idea that a company is worth the present value of all the cash it's expected to generate in the future. DCF analysis helps you answer that question by discounting those future cash flows back to their present value, taking into account the time value of money. Now, DCF analysis involves forecasting a company's future cash flows, which can be tricky. But once you have those projections, you can discount them back to their present value using a discount rate that reflects the riskiness of the investment. Let's talk about the capital asset pricing model, a cornerstone of modern finance. This model is essential for anyone looking to understand the dynamics of financial markets. It helps us understand the relationship between risk and return, which is crucial for making informed investment decisions. The CAPM says that the expected return on an investment is equal to the risk-free rate of return plus a risk premium. This risk premium reflects the investment's volatility relative to the overall market. In other words, the riskier the investment, the higher the expected return. This principle is fundamental to understanding how to balance risk and reward in your portfolio. The CAPM provides a framework for calculating the appropriate risk premium for an investment based on its beta. Beta is a measure of an investment's volatility relative to the market. The CAPM is widely used by investors to estimate the cost of equity. This is the return that investors require for investing in a company's stock, making it a vital tool in financial analysis. Let's dive into the efficient market hypothesis, a theory that has sparked endless debates among academics and investors alike. This hypothesis argues that stock prices fully reflect all available information, making it impossible to consistently beat the market. The EMH suggests that stock prices reflect this perfectly blended information, leaving no room for arbitrage or outsized returns. The EMH has three forms: weak, semi-strong, and strong. While the EMH has its limitations and critics, it highlights the efficiency of financial markets and the challenges of consistently outperforming the market. Let's explore shareholder value analysis, a management approach that prioritizes maximizing shareholder wealth. SVA argues that a company's primary goal should be to maximize its value to shareholders, typically measured by stock price appreciation and dividend payments. It emphasizes metrics like return on equity, economic value added, and free cash flow to gauge a company's effectiveness in creating shareholder value. Despite the debate, SVA remains a widely influential framework for corporate decision-making, emphasizing the importance of aligning management's actions with shareholder interests. Let's delve into economic value added, a powerful metric that goes beyond traditional accounting profits to measure a company's true economic profitability. EVA measures the difference between a company's net operating profit after taxes and its cost of capital. It tells you how much value a company is creating above and beyond the cost of the capital it employs to generate those profits. Companies with positive EVA are creating value for their shareholders, while those with negative EVA are destroying value. EVA is a valuable tool for performance measurement, capital budgeting, and incentive compensation, encouraging managers to focus on value-creating activities. All right, let's bring it all together and talk about measuring value creation, the ultimate goal for any company looking to reward its shareholders. We've covered a lot of ground, from financial ratios to valuation models, but it all boils down to this. Is a company creating value for its owners? We can look at metrics like return on equity, return on invested capital, and free cash flow to gauge a company's ability to generate returns that exceed its cost of capital. By carefully analyzing all these factors, we can get a clearer picture of a company's ability to create value for its shareholders over the long term. Congratulations, future finance masters. You've just completed a crash course in company analysis and valuation. Understanding how to value a company is like having a superpower in the world of finance. So keep learning, keep exploring, and never stop asking questions. Let's empower each other to make smarter financial decisions and achieve our financial goals.